Well, hello, and in the extended run-up to the eagerly anticipated autumn statement, which we now know is set for Wednesday the 26th of November, daily rumours persist around what the Chancellor may or may not have in store for us, as it appears the much talked about financial black hole that has extended from £22 billion to north of £50 billion. And clients often expect their professional advisors to have an insight into what may be announced, but in the absence of a direct line into the Treasury and a crystal ball, we can only make educated guesses as to what might happen, and based upon what we know so far. My name is Pete Fairchild, tax partner and national head of private clients here at Crowe, and I'm joined today by my colleague Phil Smithyes, managing director of Crowe Financial Planning UK Limited, to discuss what we see as perhaps some of the most likely announcements in our 8 to debate discussion, which, as you might expect, is purely guidance and absolutely does not constitute formal advice.
So Pete, lots of speculation almost on a daily basis around what our Chancellor might have in store for us.
Indeed.
In her autumn statement. But at least we now have a date, finally, 26th of November, although that gives us an extra month than we'd anticipated, which is not necessarily a good thing, because what it appears to be doing with clients is creating a lot more uncertainty and angst, and also allowing a lot more time for rumours to circulate and come through. And no doubt this will continue to gather pace between now and November, somewhat 7-8 weeks away. So from your perspective, what are some of the key points that might impact individuals?
Well, quite. So it's the challenge at the moment is to keep up with everything that's flying around in the rumour trail. But the freeze on personal allowances and personal tax threshold is something that we're sort of getting a bit used to. It's been confirmed it's going to be extended from its already extended date of April 2026 through to April of 2028. And of course, that creates fiscal drag, where with inflation, it just brings more individuals into the personal tax net. And there is talk further of this freeze being extended yet again through to April of 2030. So the immediate thing that springs to mind for me is if you've got individuals who are in a relationship, quite often you have one very, very high earning spouse and one spouse who's earning next to nothing and is therefore wasting personal allowances and basic rate tax bands. These are a use it or lose it situation. These things are not rolled forward from one year to the next. So therefore there are some pretty basic income tax savings that can be achieved simply by switching assets between the two spouses. So let's just quickly fill through an example. So if you've got an additional rate taxpayer who's got taxable interest income of, let's say, £50,000, and that's assessed at 45%, so it creates an income tax charge of £22,500. And let's assume in this example that the taxpayer has a non-working spouse. If the capital was gifted from one spouse to the other spouse, and they was then assessed to income tax on the interest that was received, you've then got into play straight away another personal allowance of £12,570, and the first 37,000-ish of balance is then charged to income tax at just the basic rate of 20%. That then produces an income tax charge of just shy of £7,500. So just by moving some capital between spouses has an automatic tax saving of more than £15,000. So from my perspective, that creates an immediate opportunity to use that tax saving to come and talk to someone like yourself to say, well, actually, I've now got 75% of the way there to making a contribution to my ISA for this current year.
Yeah, so I agree with you, Pete. This is an all too common problem we see particularly when I'm meeting new clients, where money is held in the wrong name, usually just through apathy. And banks in particular tend to thrive off apathy. Double that up with the fact that a lot of people haven't reviewed what rate of interest they're getting paid at the moment. And quite often we come across busy professionals who've just got that sitting in a sort of regular savings account or something that might be paying between 1 and 1.5%. And that's then taxed at 45%, meaning you're getting a net return of about 0.7 when inflation is 3.5. A simple Google will let you see that there are still accounts now paying 3.5 to 4%. So as you say, if you move that from somebody who's paying 45% tax getting 1% rate of interest to somebody getting 4% interest and paying 20% tax, the savings are huge. I mean, it's basically free money. It takes a bit of time to sort out, but well worth the doing.
Yep. So the other main sort of headline tax from time to time is capital gains tax. And similarly, spouses really should be perhaps considering gifting assets between them long before a chargeable disposal is considered. The annual exemption that has for many years been around the £12,500 a year limit has been slashed from April 2023 to £6,000 and is now frankly a bit of a paltry £3,000. So if you're not using both spouses' annual exemptions, that's costing an extra £720 of tax every single year. Now, £720 is not the hugest amount of money, but you compound that over several years and it starts to make a real difference. There are many commentators out there in the press at the moment saying that they are predicting a further hike in the rate of capital gains tax. Estimates range from another 4% on top of the 4% we saw last year, which will then get to 28%. Even going back to what was in days gone by, a flat rate of 30%, or goodness gracious me, even aligning capital gains tax rates with an individual's marginal rate of income tax, which then could see that future disposals are then taxed at 45%. So, quite a seismic change. So I think the immediate message to get out there to folk is that if a sale is being contemplated, perhaps get on with it before the 26th of November, because the precedent was set last year, of course, when there was an immediate hike in the rate of tax, and who's to say that won't happen again this year. And furthermore, the rate of capital gains tax for disposals of assets qualifying for the business asset disposal relief is 14%. That went up from 10% last April. That increases again to 18% with effect from the 6th of April 2026. So once more, if all other things being considered, if someone can get on and effect the transaction before the 5th of April 2026, you can bank that tax charge at the lower rate of 14 rather than 18%.
Yeah, so I agree with everything you said, Pete. I mean, although I've got nothing to substantiate my sort of theory, it strikes me that this first 4% rise was just a sort of precedent to what's likely to happen. If you think 4% each year ratchets things up to 32, 36, 40. So by the end of this Parliament, as you said, we could definitely see capital gains rates align with income tax rates at 40%. And I wouldn't be surprised at all to see that.
I think, Phil, then moving on to inheritance tax, which again is the tax that's probably had more rumour about it of late than most others. I think a further plea for individuals owning trading businesses and farms to consider creating a trust and passing ownership before the 5th of April 2026. And this planning will avoid the incoming £1 million cap that will apply for 100% relief from inheritance tax that will apply from April the 6th. And then just to remind you, the value in excess of that is only going to qualify for 50% relief after that date. So let's try and bring that to life perhaps with an example. If we have a business owner's trading company, let's say it's worth £2 million, and after a successful career, the individual is comfortable financially, and he takes no action to avoid family arguments, and he retains the shares and dies 10 years later when the shares are, let's say, are worth £2.5 million. So following the incoming business property relief changes from April 2026, the IHT payable will be £300,000, and there is a significant chance that the business will need to be sold in terms of being able to raise the cash to actually fund that bill. If, however, the business owner had gifted those shares into discretionary trust before the 5th of April 2026, there would be no IHT on the initial settlement, nor on the death, because this is over 7 years later. With the shares held within the trust, all share growth and dividend income falls outside the individual's estate for IHT purposes, and he retains full control of the company as a director and as the lead trustee. The trust's IHT position is unaffected by his later death because the trust instead pays IHT at the lower rate of up to 6% on every 10th anniversary of the original settlement. And at the first 10-year anniversary, the trust might face an IHT liability based on the £2.5 million value I mentioned before of just under £45,000, which has the advantage of being spread over 10 years interest-free. So if you think that through, then the beneficiaries will probably find that funding the IHT annual payments of £4,500 a year out of the business profits and or dividends far more affordable and palatable than finding a lump sum of £300,000 to actually pay the IHT on death. So in that scenario, the use of the trust has swapped a very expensive generational IHT bill for a more affordable regime, which has made it more likely that the business can remain within the family for generations going forward. And it's widely known that individuals can currently make gifts of cash and assets, known as potentially exempt transfers, where the value will of course fall outside the individual's estate for inheritance tax purposes once the donor has survived for 7 years. And the present rules see taper relief apply to failed pets if the donor then dies, but has survived at least 3 years after the date the gift was made. A strong rumour coming out from the press is that the Chancellor is considering extending the potentially exempt transfer period from 7 years to 10 years. There's more risk there of seeing a failed pet, or indeed introducing a cap on the amount that can be gifted, which feels quite intrusive, but you never know. Or abolishing taper relief, which I said applies after 3 years post-gift. So again, once more, I think if sizable gifts are being planned by individuals to their family and friends, it would be wise, I think, to get on with that and effect the transaction before the 26th of November 2025. So pensions, Phil, moving on to this wonderful topic. It's always there or thereabouts in client discussions. What are your thoughts in terms of the run-up to the budget this year?
Yeah, so what are my thoughts? I mean, I think for as long as I can remember now, there's been pre-budget speculation for years and years around changes and what might happen to pensions, all of which makes things very difficult to plan. So if we roll back to the last autumn statement from last year, where the Chancellor introduced or announced that pension funds will come under the scope for inheritance tax from April 2027 onwards, which is quite a seismic change from where we stand currently, where pension funds are effectively free from inheritance tax. And this is giving my clients a lot of angst and cause for concern, because a lot of them had viewed as their pension fund as a sort of inheritance tax planning vehicle. And that's all going to change. So there's a lot of strategic thinking now around what people should do with their pension funds, whether they should take money out and spend it or gift it, as you talked about earlier. Just incurring the tax charge now, but not that double tax charge further on, where you've got inheritance tax and then income tax from April 27 onwards. So a real conundrum for people to think about. So if I talk about where we are now in terms of pension funding, as you know, you can currently get up to 45% income tax relief on pension contributions. Now, when you think about the current climate, every time I say this out loud at a seminar, there is a bit that I think this sounds a bit too good to be true. Can you make a £10,000 gross pension contribution that only costs you £5,500 net? So the current rules do appear quite generous, and there are lots of rumours that this could change. It could be switched to just basic rate tax relief on pension contributions, or possibly a flat rate of 30%. Who knows? We've currently got annual contribution allowances of up to £60,000 gross. So they seem quite generous, I think, and I could see some potential restrictions coming in there possibly. And then you've got this ability to carry forward unused allowances from the previous 3 tax years, which means that certain individuals could contribute up to $200,000 in a tax year and possibly get 40 or 45% tax relief. So if you think a $200,000 gross pension contribution could cost you $120,000 net, there's possibly some tax savings to be made there, and those rules are possibly too generous. We shall see. So what we're definitely encouraging clients to do, Pete, is where there's an ability or an option to make pension contributions before the 26th of November, assuming you've got the cash, why take that chance? I mean, I think we can say with a high degree of confidence, income tax reliefs on pension contributions are not going to get better post-budget.
Agreed.
They are only likely to either stay the same or in all likelihood get worse. So if you're planning on making contributions this year, our advice would be to get on with it and to make contributions as soon as you can. Probably the biggest thing that's perplexing and challenging my clients at the moment is this rumour around the possibility that the 25% tax-free cash option will be withdrawn from pension funds. And that's going to create a headache for a lot of people. It's also created a dilemma for a lot of my clients. I mean, I'm of a certain age now, Pete, where I've got the ability to take my tax-free cash out. and it's something that I've been given consideration to. I think there's two issues here. A lot of people were planning to use their tax-free cash as part of their income solution in retirement. And I'd be quite surprised if that 25% option were removed altogether. But you can't say anything with any degree of confidence. There is already a restriction to tax-free cash by virtue of the lifetime allowance. So although the lifetime allowance has officially been removed, it does remain in situ for tax-free cash purposes. So most individuals will have a maximum of 25% of the lifetime allowance, and the lifetime allowance is 1.073 million. So about 262,000 is your maximum tax-free cash. Yep. So I very much doubt it would be withdrawn altogether, but I could possibly see a new cap coming in, possibly 25% of 500,000 or something like that. But we simply don't know. So clients are coming to me expecting me to have a crystal ball saying, what do you think we should do, Phil? So there's two issues here. One, in most circumstances, we have to provide our advice based on current legislation. And I think in that scenario, the advice is to sit tight. However, where clients do have a specific purpose, which might be to pay off mortgage debt, or it might be to fund a building project, or as you alluded to earlier, to make some inheritance tax planning gifts to support family members. So where there's a specific purpose such as those examples, then actually there is a stronger argument to be made for taking tax-free cash out now. Certainly anyone who's got a restriction by virtue of a sizable pension fund and the lifetime allowance, you're not going to get more than 25% of the lifetime allowance. I think we can safely say that that's not going to increase. So if you're maxed out, then there's an argument to say, why not take it out? The only caveat I would say with this is that on a normal day, the pensions industry struggles to cope with demand for people making withdrawals. At the moment, we've seen a lot of requests to take money out. And so if you do want to get in, you need to get in the queue quite quickly. And there can be no guarantee, although we're still 8 weeks away, no guarantee that the pension provider will be able to administer it in time to release your tax-free cash in time. So general guidance, probably sit tight. Who knows? But where there is a specific purpose, then at least you've got a justification for taking that withdrawal.
Well, thanks, Phil, for that detailed analysis. Are there any other key considerations that individuals may want to consider acting upon if all this speculation proves to be true?
Yeah, I think that the general advice we're giving to our clients is things are unlikely to get better, even if they don't get worse. And so therefore, if you've got funding opportunities, as I said, around pensions, why wait? Why not do it? And the same applies to ISAs. There have been rumours around the ISA contribution allowance being reduced. Currently it stands at 20,000, but there's been quite a lot of coverage in the press around cash ISA allowances possibly being reduced to £4,000. So if you've got the money available and you've got the ability to do it and you were going to fund your ISAs now, why wouldn't you do that in advance of 26th of November? So that's the general advice we're giving to our clients is if you're going to do it, get on with it because you've probably got nothing to lose. So Pete, this is one of the biggies. One of the major speculation rumours has been around potential for a wealth tax. Dare I ask, what are your thoughts on that?
Goodness gracious. Well, in my personal view, I think that's an unlikely new measure. When you think about it, the UK's got various wealth taxes anyway. You've got inheritance tax, you've got capital gains tax, you've got stamp duty land tax, and arguably you've got council tax. So do we really need another one? And a wealth tax, actually for sophisticated, wealthy, high net worth individuals, is something that I think they would be able to avoid fairly easily. So for example, if wealth tax came in and said, we're going to tax wealth in excess of £10 million, and one of your clients is sitting there with £12 million worth of assets, then a simple way to get underneath the threshold, take on £2 million worth of debt, and then you reduced your net value down. And I think besides that, it's well known and documented about the lack of resource that HMRC has had for some time. So if we have on an annual basis people trying to file wealth tax returns saying that my shares in Phil Smithyes and Co Limited are worth £5 million, then the resource available at HMRC to come forward and check those calculations and challenge those calculations, I think it's probably fairly few and far between. So I think it's going to gum up the system if we had that situation, and it just make it unworkable. So why start a problematic issue? And we have to bear in mind that there's only one country in the world that has successfully implemented and kept an annual wealth tax. That's Switzerland. Others have introduced it and then very quickly said, you know what, this is in the too difficult to deal with administratively going forward box, so we'll scrap it. Switzerland copes with it because it has other taxes that are lower by comparison to compensate for that annual wealth tax. So it works for them. They've got a great system and it works for them. I just don't see that here at the moment.
Great. Thanks, Pete. So one of the other issues that there have been coverage on is for sort of landlords and buy-to-let income. And they seem to be quite a low-hanging fruit for any government, but particularly for this government. So one of the rumours currently is whether national insurance contributions will be levied on rental income payments. Yeah. Your thoughts on that?
Well, that would be a particularly nasty one, if, in my view, Phil, if that was to be introduced. I mean, on paper, it's a very easy way to raise additional sizable revenue. But I think in practice, it's manifestly unfair because landlords in this current situation do not pay tax on their net income. Instead, landlords pay tax on their excess rents after adding back most of the mortgage interest, which in most cases is the largest cost that a landlord has to offset against their rent. So again, let's try and bring this to life by way of an example. Let's say that a landlord receives £1,200 worth of rent in a month and pays in the same month £1,000 worth of mortgage interest. So you might say, well, net income, therefore, is only £200. And prior to 2017, common sense applied, an income tax, let's say at 40%, would be applied to the £200 worth of profit, creating an income tax charge of £80. But landlords, however, are no longer entitled to deduct mortgage interest, and instead they receive a 20% tax reducer or credit to offset. So this means, going back to my example, the true position is that the income tax is applied to the rent received of £1,200 in the month. 40% of that produces a tax charge of £480, less 20% of £1,000 of mortgage interest paid, so you can offset £200. So the landlord is facing, in that scenario, a tax charge already of £280. But in reality, of course, their profit was only £200. So it's already manifestly unfair. So why would you bring in something that makes it almost unworkable? And if that was to be the case, I think we'll see a couple of scenarios. The national insurance charge being imposed would simply be passed on to landlords' tenants to increase rental charges. Landlords may start to incorporate their business because in a company situation, you still get full offset of mortgage interest relief. In a corporate situation, many landlords might say, do you know what, this is now just too much, paying far too much tax, not getting any real return on this investment, all this hard work I'm putting in, we'll just sell up and move on. So finally, Phil, to start wrapping up, any final thoughts on this rumour about the ISA contribution annual limit being reduced from £20,000 to £4,000?
Yeah, I think that would be particularly challenging for a lot of my clients. So the rumour seems to relate only to cash ISAs, so a reduction from the 20,000 limit currently in situ to just 4,000 for investors who are going to do cash ISAs. That seems particularly unfair for a lot of my clients who are retired, quite elderly, where they don't have the appetite for investment risk to invest in a stocks and shares ISA, and they don't have the longer term investment time horizon either if markets fall and their values drop. So a lot of my elderly clients will invest in cash ISAs to give them the security of that interest. And if that drops to £4,000, well, that's going to have a serious impact, especially the point you started out talking about earlier on, with the tax allowances being frozen. From next year, the state pension will be over the personal tax allowance, and therefore all pensioners with a full state pension will suddenly fall under the scope for income tax as well. So, yeah, this would be a real challenge for them and would seem quite harsh and unfair. And I can't see that it's a big revenue raiser, but who knows? We'll have to wait and see.
So there we have it. Lots to consider, lots to ponder, and we'll need to wait until the end of November before we can separate fact from fiction. However, I think, just to sum up, and to borrow your phrase you already mentioned, things ain't going to get any better. So if there is opportunity for individuals to accelerate planning, to make pension contributions, make donations to charity, to swap funds between husbands and wives, effect a transaction to bank capital gains tax rates, now's the time to get cracking.
Yeah, agreed, Pete. And don't forget, if you're planning on making gifts as well, for inheritance tax purposes, then get that underway too.
Yeah, quite. Agreed. Thank you very much.
Thank you.